Joe Hoffman. Joe is CEO of Currency Management in Mesero. He is live from Seattle, and he will be talking to us about ESG and currency trading. Over to you, Joe. Thank you.
Thank you, Catherine. Thank you, everyone, for attending this session. I'm so happy to be here today, and I would like to thank ASI for allowing me to take part in this conference again. So I thought it'd be interesting, given the emphasis on ESG over the last several years, to talk a little bit about this topic, currency and ESG, and some of the research that we've done in this space. So I'll start off by presenting a case for including currency in an ESG fixed income and equity portfolio and show how it doesn't impact the rating of the ESG score, but does enhance the risk-adjusted returns. And then finally, I'll talk a little bit about how we've incorporated ESG data into our systematic trading process. All right, so as the demand for ESG equities and fixed income to increase, investors are going to look for ways to enhance these type of portfolios while adhering to their ESG guidelines. There's a problem though, as more and more investors continue to flock to these highly rated ESG securities and more money comes into this space, expected returns could decline or come down. I'm not saying they will, but as with any asset class, as the more investors come into it, the opportunity decline. So what can investors do? Well, they can look at using currency as a solution. Now, most institutional investors have already taken into account and managed risk. Stu touched on this a little bit already. But most institutional investors have focused less on currency as a return source. So there's a number of benefits for using currency as a return source. First of all, in an ESG portfolio, it's considered being ESG neutral. Currency is considered ESG neutral. So right now, this is how MSCI treats currency when they're evaluating and rating currency or a portfolio from an ESG perspective. So it doesn't have a positive or a negative impact. Next, it's a diversifier. Currency has a low to negative correlation with both equity and fixed portfolios. And it's very capital efficient. It doesn't need to be fully liquid, and as a result, you don't need to liquidate your portfolio. And finally, it's a unique opportunity set. The FX market is the largest liquid market in the world, where most of the participants are not profit seeking. And as a result, it creates a multitude of opportunities. So given this, we wanted to see what a small allocation of currency would look like and how it would impact an ESG equity portfolio. All right, so on this slide here, for ESG equities, we have the MSCI World ESG Index as our proxy for ESG equities. For Currency Alpha, we use the Barclays Traders Index, which is a equally weighted index of different Currency Alpha programs. And the time frame we used is between September 2007 and December 2020. Now, we use this time frame because this is as far back as the MSCI index would go. Now, you can looking at this slide in the table on the upper left-hand side, you can see that the annualized returns of the ESG equity portfolio alone was about 3.7% per annum, with annualized risk of just under 17%. So your return to risk ratio is only about 0.22. During the same period of time, the Currency Alpha, the proxy that we have here, had an annualized return of about 2.6%, with annualized risk of about 2.44. So the return to risk ratio is just over 1. You can see that just by adding 20% of currency to this ESG equity portfolio, you would have increased or improved the annualized returns by about 50 basis points per annum with no increased risk. And in fact, risk in this case actually came down slightly. As a result, the return to risk ratio actually improved. And part of the reason for this lack of no increase in risk is you can see in the chart on the upper right-hand side, it illustrates the rolling 12-month correlation between currency and equities. You can see it hovers around 0 to slightly negative. Now, on the chart on the bottom, you can see the excess returns that would be contributed from currency over this period. Over this entire period, it would be a cumulative return of about 7% that would have been added. Now, during this period, ESG equities actually underperformed 5 different years. So having currency as a part of your portfolio would have helped offset some of those losses. So now that we've looked at the ESG equity portfolio, we thought we'd look at a fixed income portfolio. Okay, so for the ESG bond portfolio, we use the Barclays MSCI US High Yield Liquid Corporate Sustainability SRI Index as our proxy for bonds. And then for Currency Alpha, we use the same proxy as we did on the previous slide. The time period here is between December 2006 and end of December 2020. You can see here ESG bonds, annualized return was about 0.6% with annualized risk of just around 6%. So your return to risk ratio is about 0.9. By adding 20% currency in this case, you again improved your annualized return by about 50%, or 50 basis points, not 50%. You don't increase your risk of your overall portfolio as well. You can see that your annualized risk is at just around 6%, just as an ESG bond only portfolio was as well. And so the return to risk ratio as a result is improved from just over 1 from 0.92. And you can see the rolling 12-month correlation between the bonds and the currency. And again, it hovers around 0 to slightly negative. Now, on the excess returns on the chart below, again, it's a cumulative return of about 7% over this period of time. Unlike equities, the ESG fixed income actually underperformed 4 years as opposed to 5. So now that we've talked a little bit about how you can incorporate currency into an ESG portfolio, we thought we'd talk a little bit about how we've integrated ESG data into our systematic FX trading program. So ESG data is comprised of a wide range of factors measuring how much a business or a country, considers environmental risks, social criteria, or even promotes transparency around their decision-making process, whether it's their investments or just around their pure governance. And unlike equities and bonds that are tied to a company, currencies are tied to an underlying country and economy. So as a result, there's a number of factors that need to be assessed around this particular country's economy and political structure. And given the availability of ESG data, we wanted to build a model that could demonstrate and bring and add value to our overall alpha strategy. Now, within our alpha strategy, we have a number of different models. In this case, we're talking about our relative value model. Our relative value model relies on a number of different signals and indicators based on a number of different economic factors. For today's purpose, I'm just focusing on the ESG factors, which we saw that had a low correlation and was quite complementary to the other indicators within our value model. So what do I mean by relative value? So when you buy, you have an ESG portfolio of equities or fixed income, you either hold the security or you don't. When you enter into a currency trade, you either long one currency, but you're also short another. So for example, if you wanted to buy Turkish lira, you would have to sell Australian dollar. So it's easy to basically screen out your non-ESG currencies. But what you can do is go short non-ESG currencies and go long ESG compliant currencies. So how does the process work? So first of all, the primary purpose is how do we basically source and aggregate our data to get it in a standardized format. Now, without good data, this process wouldn't be possible. So we built a very systematic process where we pull data from a number of different sources, so OECD, World Bank, and where we bring in the data, we evaluate it, we rank it, we score it, and we're looking at 51 indicators. And this data comes in all shapes and sizes. So we have also had to build the technology where we can bring in the data, cleanse it, reformat it, and restructure it again to get it into a standardized format. Now, once this is done, we run an algorithm to really check how successful or how compatible the underlying indicators are with the incoming market prices. Now, those indicators that are compatible get promoted within the model, and those that aren't get demoted. Now, our goal with any model or any algorithm for that matter is to maximize returns, reduce the risk, any drawdown. So for this purpose, what we do is we run a Sortino ratio on each underlying indicator. And we feel like the Sortino ratio is a good measure of risk on the downside, whereas other risk measures may place the same amount of emphasis on the upside as the downside. So for us, we're concerned more with downside risk. Now, our approach is back tested over about a 10-year period. And we looked at about 28 currency pairs. So the first step in the process is we run and compute the historical returns of the relative value strategy of each indicator. So from the data from each indicator, we rank the currencies from the highest ESG score to the lowest, and we calculate those returns. Now, when we're calculating those returns, at least in our back testing, we obviously took into account carry, transaction costs, because we wanted to make sure that this reflected the real world results. Now, after the historical returns are calculated, we'll run the returns on a shorter time frame to calculate the Sortino ratio. Usually that time frame can say 90 days. Now, we run that on each indicator, and each indicator that has a Sortino ratio above 0 will get a score of 1. One below, the indicators with a score of below 0 get a score of 0. So then we can basically aggregate and build and create a weighted average basket, all the indicators with a score of 1, to create our basket of long and short currencies for the next period. And given this data is not updated too frequently, you can see that this is not a very high turnover type strategy. Now, given the research that we did, it'd be interesting to show you just on average what the ESG scores are for each currency within 28 currencies that we evaluated. Here on the left-hand side, you can see that Indonesia, Philippines, India, and Turkey on the more on the EM side had the lower ESG scores, whereas those on the developed currencies, including Australia, Switzerland, and some of the Nordics, had higher ESG scores. Now, when we started this process, we weren't sure, if there was any value for underlying ESG data, and also we weren't sure of the ESG data which ones would actually be the most valuable. So when we looked through and did our evaluation and research, we found that actually the environmental data had the least impact or the least value within our overall model, whereas social governance had the most impact. So you can see that here on this slide, where the green bars are the environmental and the governance are yellow and blue. Now, given this, how did this perform? So here, you can see that the cumulative return over the last 11 years is about 25%. Again, this is just one small signal within our overall relative value model. Average returns, depending on the time period, ranged from anywhere from 50 basis points to over 2%. So we were quite happy to see that this model continues to add value to our overall plan or program. And it has been live since earlier this year as well. So we have did the research, we've integrated it within our overall strategy. We were quite happy with the results so far. Now, I know I've covered a lot of materials in a short period of time. If you're interested in hearing more about these, we do have some papers available on each of these topics. But if you could take two things home today, I guess the first thing is that Currency Alpha can be added in the ESG portfolio. It will enhance returns with little added risk, and it won't impact the ESG score of that portfolio. And then finally, ESG data, there's been such a huge focus on ESG and the equity and fixed income space and data in that area. ESG data is now available at the country level and can be incorporated to look at your currencies and create a model that's uncorrelated with other signals and other investment processes in your program. So as ESG continues to gain momentum, we believe that integrating ESG beyond standard asset classes will continue to increase, and currency is just one of those. So that's it for my time. I hope you enjoyed our insights, and feel free to contact me with any questions. Thank you.